Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head the G10FX strategy team sitting here in the U.S., and today we're going to be focusing fully on the U.S., and to do that, I'm very happy to be joined by our chief U.S. economist, Kevin Cummins, to break down some of the big data points we've got recently with a specific focus on the inflation number that we know the market was very clued into. So, Kevin, thanks very much for joining.
Thanks for having me, Brian.
So I want to start there with CPI. It feels like the market really sets their calendar to the monthly releases of inflation, not just in the US, but across major economies and major FX. It feels like because the market is so focused on the Fed and the outlook for the Fed and how that feeds into other central banks, we know relative interest rates are critical for FX. And so it feels like US CPI in any given month feels like it's the print that has the biggest scope to move the market. And so clearly a lot of focus on these inflation numbers. The inflation numbers we've gotten to start the year were clearly not what the Fed was hoping for, certainly some strength, some unexpected strength, I would say, kind of pushing out this expected timing of Fed easing. We just got an update on the consumer price index yesterday as we record on Thursday. Kevin, what did you see in the CPI? What was the breakdown there, and how do you feel about the print?
Yeah, I mean, I think going into the report, as you mentioned, there's been so much focus on inflation and making sure that the Fed can feel confident enough that inflation is going back down at their 2% target. So, markets, like you said, are really taking their cues on the month-to-month prints on this report, particularly on the core side. And I think, we were a little bit higher than the general consensus going into the number. So it wasn't all that different than the consensus expectations. It came in at 0.3. And I think, it is a little bit of a sense of a relief that we didn't get the worst outcome of another 0.4 or even stronger from the Fed's perspective. So, it's a very small step in the right direction. But at this point, it's far from sufficient for Fed officials to feel like inflation's now going back down to 2%. So, I think at the end of the day, by itself, it really doesn't change the dynamic that much. But it is a small step in that direction. We just need to see, and the Fed needs to see, additional readings that are consistent with the idea that inflation is going back down to 2%.
Yeah, I think you hit the nail on the head there as far as the foreign exchange market reaction, which is a bit of a relief that we didn't see the sort of worst case scenario of higher than expected inflation once again, right? What we've been talking about on this podcast, focusing on FX, is talking about how some of the recent activity data may be clipping some of the hawkish extremes of Fed pricing, and the dollar has sold off a bit on the back of that. In order to get something like rate hikes back on the table, for example, feels like the way that Powell and the Fed have been talking, they need to see sustained upside in the data, not just continuation of strong, but clear signs of acceleration. And some of the activity data we've seen looks like it's taken a step back in the April data that's been released so far in May. And I think you sort of hit the nail on the head, basically saying the market was expecting a pretty solid print, and a print in line with the consensus maybe is a bit of a relief in terms of, we've come off such a persistent pace of outperformance, of upward surprises, that something in line with the consensus, even though it was a pretty high consensus, maybe acts as a bit of a relief, and the dollar sold off a bit. But I do want to ask you a little bit about some of the activity data as well. Sort of hinted at this, but some of the activity data we've seen released for April so far in the month of May have been a bit softer than expected in some cases. I'd argue Goldilocks in some cases. In other cases, you've seen some slowdowns. Retail sales is a good example. Seen some confidence numbers, consumer confidence numbers look like they've taken a bit of a dip. How are you feeling about the early activity data we've seen for the second quarter, especially when we come off such a strong start to the year in the first quarter?
Yeah, and I think that's important now because, the Fed having taken away any sort of directional bias on rates, it seems like the next move is certainly going to be lower, not higher. But the Fed is obviously very concerned about inflation at this standpoint. But the growth data still do matter. And if we are starting to see some cracks, for example, in the labor market, if you look at jobless claims, now they historically are still very low, even with this morning's number falling 10,000 on the latest week. They have started to at least raise the possibility that they may be creeping up from their lows. And, whether or not that carries over to the non-farm payroll report that we'll get in early June ahead of that June FOMC meeting, we'll see. We still have some time before that. But as you mentioned, the retail sales data were a little bit of a disappointment in April relative to the strong gain that we saw in March. That March gain was revised down a little bit. So, there's a lot potential for some slowing in the US this year relative to last year. A lot of those tailwinds that we saw last year seem to be fading a bit. So, while even if you look at the latest data and look across the 2 months, it's still reasonably solid. It certainly is a step down from where we saw consumption growth of plus 3% at the end of last year. From a statistical platform perspective, given the strength that Q1 finished with, the Q2 pace is starting, even with kind of the softer April. It is going to start with a pretty high base level to get going for the quarter. We'll see at the end of the month on May 31st, we'll get the personal income and spending report, and we'll see how consumption for the month, that includes both goods spending, which mostly is retail sales covers, but also services spending. And we'll see how that comes in. But based on those retail sales data, we're probably going to barely see any growth in real terms for consumption. Nominal terms will probably have a little bit of a lift, but in inflation adjusted terms, it seems like we're going to barely get any sort of growth. And that's, on a month-to-month basis, a step down from where we were, certainly through most of last year and early this year. A lot of the rhetoric is, the resilience in the economy. This may be a little bit of evidence that things are beginning to cool off, and the earlier Fed rate hikes and tightening in policy still has a ways to go on the broader domestic economy and in growth, in not just on the inflation side. The one other point that I point out about the CPI yesterday, as you mentioned at the start, the possible implications for the PCE number that we'll get also when we get those important personal income and spending data. We'll get on the core PCE, which is the Fed's preferred measure of inflation. And from that perspective, yesterday's report was a little bit more encouraging, I think, than heading into the report, in that some of the components that carry over to the PCE were a little bit softer, a touch, than we assumed going into it. So we think, unlike the CPI, which rounded to 0.3, it was a 0.29 on an unrounded basis. So it rounded, up a little bit. The core PCE probably only came in at a 0.2 on a month-to-month basis. So again, that's a step in the right direction. I wouldn't really get too excited about it and convinced that inflation's going back down, but it is encouraging. And like you said, you avoided the worst case scenario of it reaccelerating for whatever reason. And if that's right, the year over year pace could moderate to 2.7, which would be, I think, a 3-year low. So that would certainly be encouraging news for the Fed. But I think, at the end of the day, the Fed's going to need to see, because of the stickiness in the first quarter, this is a step in the right direction. But, as Powell mentioned in his press conference after that last meeting, he said 1 reading, 2 readings, you can kind of chalk up to monthly noise. But when you see a third, that's when you start to, really get a little bit, you have to take it for what it was. And that, they've lost a little bit of confidence that inflation's going back down to 2%. It's their base case that it will, but, 1 report doesn't do it. They probably need to see a string of these, like maybe 3 or 4, before they can have that level of conviction that they're going to start cutting rates. So, this doesn't resolve the issue, but it suggests that further progress could be in the pipeline. We'll just have to see and get that sort of confirmation in the coming months.
Yeah, you definitely touched on a lot of important points there, but I would just emphasize the slowing in some of the activity data does appear to be consistent with some of the slowing that we sort of talked about on the edges of the labor market. For example, things like challenger job cuts. You mentioned initial jobless claims, maybe some signs of moving higher there. The JOLTS numbers, you're seeing some improvement in the supply versus demand of labor side. All of these are things that the Fed and others have been talking about as signs of disinflation pressure potentially coming through the pipeline. And I think it's just a matter of, will the Fed get that information? Will the Fed see those signs? Will they see them consistently? And really, what does it take to get the Fed into a mode where they would consider easing? So I want to ask you more specifically on your expectations for the Fed as we come out of this several weeks of, I think, more constructive data from a Fed side, right? That you're seeing some signs of slowing, maybe moderation rather than full slowdown, closer to the kind of soft landing that I think the Fed's, we're heading maybe back in that direction rather than towards reacceleration, which looked like it might have been a real risk as recently as just a month or two ago. What are you thinking on the timing of the next move? And what do you think is the standard that the Fed needs to see in order to maybe make the move earlier?
Yeah, so you bring up a lot of good points. I mean, I think the Fed, that hurdle in the wake of the extended strength that we saw in the core inflation numbers at the end of the first quarter, I think that kind of reset the bar even a little bit higher than what they assumed coming into the year. So it wasn't all that long ago that we pushed out our call from 3 cuts this year to only 1 at the end of the year in December. I wouldn't necessarily rule out an additional cut, whether that would come in November or September. I think that's probably the earliest of September. I think a July cut, it probably won't have enough runway between now and then. It's not to say it can't happen, but the likelihood of that, I think, are pretty low at this point. But I think once we go into the fall, that's where it becomes a little bit more challenging to have a really strong conviction whether or not they can go, say, as early as September. Of course, they have the election. I think the Fed and Powell has made pretty clear his intentions of doing what's right for the broader economy and for the country as a whole, that if they needed to adjust policy ahead of an election, that they wouldn't hesitate to do so. But I think, now that there's still enough ambiguity in the data, I think the talk of a first cut at this point is still premature. That getting closer to an election, there may be some on the committee that really want to see things starting to erode, that they feel like they got to start cutting rates. I think what we'll be telling is we'll get an update. We'll have one more inflation report from the CPI the morning of the FOMC meeting in June. But we'll get the updated dot plot. And it's, I'm sure undoubtedly officials are going to pare back the number of cuts they expect. If you remember back in March, they assumed 3 cuts by the end of this year in their dot plot, but it was a pretty close call between 2 and 3. It really didn't, it wasn't a very high conviction call whether it was 3 or 2. So I would think at a minimum, you're going to see the dots go back down to 2 or maybe even 1 by the end of this year. We'll see. The morning of the meeting, we'll get that core CPI. It could be a really important number as we go into that report that we just don't know. So between now and that FOMC meeting, we really don't get all that much new information. Of course, we'll get, as I mentioned, on the 31st, we'll get the personal income and spending report. So we'll see that core PCE deflator. And I don't want to emphasize it that this is going to, get talks about a first cut really soon. But I think it'll be, they're signaling or potential signaling that, they can cut twice or as much as twice this year if they feel like that number on June 11th, I believe it is, for the CPI is released. So if that were to come, say, on the softer side, does that nudge what may be a base case of 2 cuts this year down to 1? We'll see. I mean, time will tell. Between now and then, they'll have another employment report. But they really don't have too much new information heading into that June FOMC relative to now. So we'll have to see where it comes. But yeah, our own base case is that they begin rate cuts in December. And I'd say if I was wrong, I think it could potentially come in September or possibly even November. But I think the Fed wants to go into a rate easing cycle with a lot of conviction. So I think that Powell would prefer to have, a very strong consensus view that you wouldn't get any sort of dissents. And I'm just not sure, given that the year-on-year paces of inflation, at least as we see them over the summer, are still going to be lingering around 2.7 or 2.8 for a while. So optically, it may be a little bit more of a challenge to get that overwhelming consensus before you start an easing cycle.
I think one of the thematic debates on the expectations around the Fed has been this question of, would they be willing to preempt a slowdown in growth and sort of ease, I don't want to say prematurely, but take out a bit of insurance against slowing growth? Or rather, would they just prefer to wait until the data give them every indication that it's time to ease before going? Now, I'll be the first to admit that I was very much in the camp of the Fed having the opportunity to take out some insurance on slowing growth and not necessarily need a growth slowdown to ease. But it certainly sounds like, from everything that they've been saying, that there is a desire to get this right. And if it takes a little bit longer, as long as the growth data allow them of that flexibility to keep waiting, it seems like that hawkish bias is the one they are sort of signaling and trying to keep. And so, to the point you made, it just feels like almost all the data have to come in exactly right in order to put July on the table. And even even September feels like it could be a far cry, just because of the need for consistency, consistent and consecutive progress on not just growth, but on inflation as well. I mean, Powell and the Fed talk about bumpy path to 2% on inflation, right? That sort of almost conflicts with this idea of consecutive progress, that it feels like every month you're at risk of getting a surprise upside beat in a particular category on inflation that sort of resets the Fed's confidence in that timing. And so, to your point, I think it's difficult it's difficult to construct a scenario where the Fed is easing in September at this point, because they've shown basically zero preference towards preempting. And it feels like you just don't have enough time really to get that unless all the data come in the right direction. And certainly from the foreign exchange perspective, I think what this means is, we've seen the market and the dollar take their cue from the data. And over the first quarter of the year, the dollar strengthened quite significantly as the market priced out a lot of that Fed easing bias we had heading into the end of 2023 and early 2024, based on the data. Now, I think you're starting to see the market seeing a little bit of what I call green shoots, in terms of maybe some slowing in the data in the US, maybe some slowing activity, CPI that seems to have avoided the worst case scenario and maybe pointing towards a little bit more moderation, more obvious moderation in the PCE deflator. That's all coming against the backdrop where dollar positioning looks like it's pretty extended in the long direction, right? If you look at growth expectations, U.S. expectations for U.S. GDP growth in the first quarter skyrocketed, while the rest of the world was pretty stable, right? And I think FX markets are still priced for that differentiation, that divergence between the Fed and everywhere else. And I think that's been boosting the dollar and led to some pretty extended dollar long positioning. And I think what you've seen recently is maybe some paring back of that positioning, maybe moving a little bit closer to square, as it becomes increasingly difficult for the US economy to outperform this consensus, which had been repeatedly ratcheted up as the data kept surprising us, right? So I think from the dollar side, it's a balancing act between when is the right moment in terms of the economy's actually slowing versus, yes, it's clear that we're sort of clipping these hawkish extremes from pricing, and dollar positioning looks like it's a bit extended and is sort of reacting to some of these data that are not as extremely hawkish. Is this the beginning of more sustained slowdown, or is this another example of choppy, bumpy progress, one that's not necessarily conducive to a big evolution in Fed pricing and a big dollar weakness? And I feel like it's probably leaning more on the latter side, just because it's so difficult to get a really strong sense that the economy is slowing. We've had these sort of false starts on the US before, and I think For FX, that's super important too, because we know all these other central banks expectations are, for rightly or wrongly, linked into the Fed, right? The ECB looks pretty locked in to be cutting in June, but their ability to cut on a sustained basis or their willingness to do so, it may still be limited if the Fed's potentially not moving till December, Kevin, as you mentioned. And so that ability for interest rates to diverge in a significant way, which has major implications for currencies if it would, could be limited if central banks see a little bit of elasticity in terms of their willingness or ability to move too far ahead of the Fed. It feels like it's probably too early to be expecting this to be the start of a more sustained downtrend. And I think that's how investors should be thinking about the dollar here as we move into these next couple of weeks and into the June FOMC. So, Kevin, I want to say thank you very much for joining. I think this was a really great discussion and wrap up of the data. And to our listeners, thanks so much for listening to today's episode. If you enjoyed this podcast, please consider giving it a like and also subscribing to our channel so that you can get our latest podcasts the moment they're released. Thank you very much.